Hi, Steve. Hi, James. Thanks for joining me today. We're here to have our first DFM market update. I think we'll start with the US, where, of course, the biggest news has been Donald Trump and his tariffs. Do we think they're a short term plan, a negotiating tactic, or are they part of a longer term movement? Are tariffs here to stay?
The answer is yes, they're here to stay, and they are both a short-term negotiating tactic and a long-term plan. So I'm thinking of it in sort of two strands, which fall into both those categories. So we'll hear today something that approximates a more permanent, more sustained tariff landscape in what the U.S. administration has called Liberation Day. There'll be reciprocal tariffs, probably with some augmented elements to it above and beyond the reciprocal tariffs. But Donald Trump's going to carry on using sort of emergency powers to impose additional tariffs, which will be the sort of on-off type of tariff. So there's two strands, one of which is much more permanent, much more sustained, and then another sort of explosive, more headline-grabbing side of the tariff. So two strands.
Right, okay. US equity markets, they had performed really strongly towards the end of last year. They've obviously come off a fair bit, on the tariff news. Do you think that's been justified?
Yeah, I think so. I mean, the big run up in US equities that you're talking about had them more or less priced to perfection. So valuations were quite high, which sort of predicated on sustained levels of growth. But it's the policy uncertainty that's associated with these explosive element of the tariffs that I'm talking about. The will they, won't they stay on at what rate and for which countries, all these kind of things. So there's a great deal of uncertainty associated with that policy approach, which I think ultimately is going to have a detrimental impact on growth to some extent, at least to the extent that growth is no longer going to be quite as high as it was without the policy uncertainty. So to some extent, yeah, I think investors are justified to be slightly more concerned with the high levels of valuations that we saw at the back end of last year.
Okay, thanks for that. And James, tariffs are something we discuss all the time in investment committees. How were portfolios positioned, even before Donald Trump was elected to account for this situation?
Well, late last year, at our final committee meeting of 2024, we reduced our US tech exposure. So we'd had a good run in those stocks throughout the year, but we were, as Steve mentioned, concerned about valuations in those businesses. So we wanted to trim the exposure there and reallocate that capital to more, say, defensive or counter-cyclical areas across US markets. So the likes of healthcare stocks, utilities, which to an extent can have somewhat of an immunity to the state of the US economy. So, regardless of whether the economy is strong or weakening, individuals are spending on healthcare, spending on utilities. So, during the recent period of market volatility, those healthcare stocks and utilities positions have really held up well by comparison to the technology stock exposure that we've had in portfolios.
So, if the tariffs aren't a short term negotiation tactic, what's the long term objective?
Well, there are a couple of schools of thought on that. So some people do think it's a short-term negotiating tactic, but I'm of the view that these are going to be sustained, like I said earlier. But I think the ultimate long-term goal for the Trump administration is to encourage more and more actual manufacturing inside the borders of America. So I think this is about the reindustrialization of America. It ties into a couple of things. Like Scott Bessent, the Treasury Secretary's objectives, tie into this quite nicely. And it's got a sort of, there's a theme running throughout, which is the reindustrialization. So the Treasury Secretary, for example, has got his triple threes or his three arrows, whatever you want to call it. But basically, he's aiming for 3% real GDP growth per annum. He's aiming for longer term interest rates to be back down at 3%. So 10-year Treasury, he wants that yield back down at 3%. And also he wants the increased energy output to be the equivalent of sort of 3 million barrels per day. So that's where the threes come from. But if you think about what those are trying to achieve, all of those actually are pretty good for to encourage manufacturing in the US. You've got lower energy prices through increased energy production because manufacturing is quite energy intensive. You've got lower longer term interest rates. And again, all of this reindustrialization, this shifting of the manufacturing base from overseas inside to America is pretty capital intensive too. So you need to borrow a lot of money. The cheaper you do that, the more successful you're going to be. And of course, you need a pretty strong US economy so that there's a sort of consumer base to attract businesses to carry on doing it. So I think the tariffs are a pretty important aspect thereof. So in two regards, first, it's a carrot and it's a stick. So the stick is obviously if you manufacture outside of the US, you face these tariffs, and that's going to benefit companies that manufacture inside the US. So there's the carrot and the stick to some extent. But also the real carrot is going to be in lower costs, lower taxation, which are going to be at least part funded by the revenue brought in from the tariffs. So I think there's a theme, there's a coherent theme that runs through, which you can sort of pithily describe as the reindustrialization of America.
So all those factors you've just discussed, they sound like they should actually be beneficial for US domestic stocks. Is there anything in the portfolios, that would benefit from that?
Yeah, we've got a more general exposure throughout. So we've recently increased our exposure to companies that are outside the sort of Mag 7. So we've expanded our US equity exposure, and in doing so, we've increased quite dramatically our industrial sector exposure too, which quite likely will benefit in the long run. The issue that we've got is that a lot of the policy consequences that I'm talking about, there are good and bad, and I think these were pretty well understood prior to Trump winning the election. There are going to be good and bad aspects of this. What was the sequence going to be? Was it going to be some good stuff, some bad stuff mixed in? It's quite clear now that the bad stuff comes first. The tariffs, the uncertainty associated with all of this, they're sort of front loaded. So we expect there to be some really positive aspects beyond this, but the market probably will be more cognizant of those positive aspects when we get the carrot end of the deal rather than the stick.
And just to follow on from that, Ollie, within our US equity component for portfolios, we recently introduced an equally weighted strategy. So what that does for us is it helps to reduce that reliance on those mega cap tech businesses, the large market capitalization businesses. Broadens our exposure on that basis. And like Steve mentioned, in terms of Trump's tariffs to reindustrialize the US, these adjustments that we've made to portfolios helps us gain exposure to certain elements that will benefit from that trade.
Thanks for that, James. So tariffs may be inflationary. Bringing it a bit closer to home, is there going to be any knock-on effects on the level of inflation in the UK?
Yeah, I think there will. I don't think there's too much doubt that tariffs are inflationary. The key question is how inflationary, and where might that inflation be felt. So there's a couple of schools of thought on this. I happen to sit on the side of the fence that suggests that the inflation aspects of these tariffs is not the major issue. The major issue is the uncertainty associated with it and the detriment to the outlook for economic growth. The key question is how inflationary are they and where will that inflation be felt? So undoubtedly there's going to be a inflationary aspect. The question is how much of an inflationary aspect. So there's a question marks about what the pass-through rate is. I'm sit on the side of the fence that happens to think that the pass-through rate is going to be relatively low. So the inflationary aspects of the tariffs is not my major concern. My major concern would be the uncertainty associated with it having a detrimental impact on growth. But I'm very much alive to the risks associated with the inflationary impact of them. Inflation is sticky in the US in particular. It's well above the central bank's target, and inflation in the UK is also well above our central bank's target. So the latest figures were 2.8. I'm guessing that by the time the March numbers come in, they're around about 2.82. But we're going to see once we get beyond March, we're going to see a surge in UK inflation up to maybe 3.4, 3.5, somewhere like that, maybe even 3.6. We've got a big step up in inflation that is more or less baked into the cake already, which is going to happen regardless of whether there's any tariffs. So the question is, will those tariffs sort of augment? Will it exaggerate that step up in inflation that we've got to some extent? We're almost certainly going to see high rates of inflation in the UK.
Well, I guess the obvious question then, following on from that, is if we are going to get these high rates of inflation, do the Bank of England have any room to keep, moving interest rates downwards?
Yes, is the answer to that. I think this is what's going to surprise quite a few commentators and certainly quite a few investors. What we're going to see, let me tell you what the market is pricing in, rather than making a very clear speculation about what we might see. The market currently is pricing in, so bank rate is currently 4.5%. By the end of the year, the market is currently priced for that to be about 4%. So another 0.5% or 50 basis points of interest rate cuts. Now, these are priced into the market, even though at the same time, the market is also pricing in a reasonable expectation for inflation to get to about 3.8% by the time that we get to September. So that the obvious question is, how on earth can the Bank of England justify further cuts in interest rates in the face of a near doubling of the inflation targets? The inflation target's 2%. We get to 3.8. Some people speculate that we could get to 4, but that would be double the target. So even in those circumstances, the market is fairly expectant of sustained interest rate cuts in that environment.
And why is that?
The reason for that is that the increase in inflation that we are very likely to see in April is the effect of price rises that the Bank of England can do very little about. So we're talking about changes in the Ofgem price cap, stuff like that. A lot of prices are automatically increased in line with inflation in the prior period, if you see what I mean. So it's not necessarily that the UK economy is overheating, and that a increase in interest rates would bring that overheating down. These are sort of fairly automatic prices that the Bank of England wouldn't usually respond to. And what the Bank of England is of the view of is that interest rates at 4.5 are enough to slow the economy down to some extent. So we're in what the Bank of England might describe as tight monetary policy. So we've got a rate of interest which is tight enough to slow or to lower the pace of economic expansion. Because what the bank's trying to do is bring the demand for goods and services into line with the ability of the economy to supply goods and services. So if the demand is higher than goods and services, the ability to supply goods and services, then you might have an inflationary impact. So the bank considers current interest rates to be enough to bring demand down to some extent. And as we move forward, the bank wants to just ease off the extent to which it is slowing the economy in line with what it expects to be. The bank still expects inflation to reach the 2% target. It's just that between now and the point it does expect inflation to hit the target, we're going to see these sort of imputed price rises, these automatic price rises come in during the April period and onwards.
So how are those high rates of inflation going to affect the UK equity markets moving forwards?
Well, ordinarily, you might anticipate that near double rates of target inflation wouldn't be particularly good for the equity market. But as I alluded to, the market is pretty well understanding that these rates of inflation, it's pretty well embedded in the price already. So UK equities have fantastic levels of valuation. We think they're really attractive from a valuation perspective. And the Bank of England is still committed to bringing down interest rates. That ought to bring down longer term interest rates with it. So that's generally quite supportive of the equity market, in spite of the. So it's more. If it was unexpected inflation, that would be much more detrimental. But this is broadly anticipated, and it's broadly anticipated not to be a sustained increase in inflation too. So interest rates will come down with it. The equity market probably will respond quite positively to that.
And you mentioned UK equities are attractive on a valuation basis. What does that mean exactly?
Well, the end effect of that is that there's usually quite a high correlation between the ultimate return an investor secures and the price that they pay for that. And we use a sort of various valuation metrics to give us an indication of how high the price is currently being paid relative to the expected return. So the lower your valuation, usually over given a reasonable period of time, the higher your returns.
And just following on from that, Sally, in terms of our UK exposure within portfolios, we did in fact reduce small and mid cap exposure the last part of last year. That was on the basis of investor sentiment following the general election and the autumn budget hadn't returned to markets. However, we do retain a marginal exposure to UK mid and small caps, and that's on the basis of more favourable valuations versus elsewhere in global capital markets. Within that UK exposure, we also hold large caps. So whereas mid and small caps, we'd expect them to benefit significantly from a reduced interest rate environment, we do have that larger cap exposure with more overseas revenue streams to really shore up that component for portfolios.
So, moving away from equities, what are our expectations for the bond component of portfolios?
Well, there are two elements to highlight here. Number one is we expect government bonds in particular, but also some high quality corporate bonds to act as a sort of hedge to some of the major risks that are out there. So if the equity market takes a tumble for whatever reason, we would expect a response from the government bond component of the portfolios to be quite positive in those circumstances. That's a quite usual response. It doesn't happen in every circumstance, but it's our general expectation, certainly from where we are today. The other element to that would be that we think that longer term interest rates are going to come down. Inflation is going to moderate. Central banks are generally speaking going to take interest rates down. That should have a broader impact on longer term interest rates. So the longer term interest rates will moderate from here, and that'll have an uplifting effect on the price of bonds. So we expect reasonable returns from government bonds, from investment grade corporate bonds. We're a little light on high yield bonds. So some of the sort of less well regarded corporates out there that issue bonds would usually attract a much higher yield. Those are called high yield bonds for fairly obvious reasons. But we're fairly light on high yield bonds at this moment in time because we think that the extra level of return that you get in high yield bonds isn't quite enough to compensate us for the risks of default that's there. So one of the things we'll be looking out for is strong returns from government bonds. And as and if we get strong returns from government bonds, they ought to coincide with less strong returns from, say, high yield bonds, and then we'll rotate some of the capital in the portfolios into high yield bonds at a more opportune moment.
Well, thanks for that, Steve. And thanks for your insight today, also, James. It's been really interesting.